If someone erased everything I built and told me I have to start over in 2026 with nothing more than 2 stock picks, I know exactly what I'd buy. Not 3, not 5, 2, just 2 stocks, and I'd put everything I could into them. Because after 7 decades watching the markets, after building Berkshire Hathaway from a struggling textile mill into one of the world's most valuable companies, after making every mistake you can make and learning from each one, I've distilled investing down to its essence. And that essence tells me that in 2026, if I had to start from scratch, these 2 stocks would be my foundation. Everything else would be secondary. These 2 would be primary. Now, before I tell you what they are, you need to understand why I'd choose only 2. Because most people, when they're starting over, when they're building wealth from nothing, they make the mistake of diversification. They buy 10 stocks, 20 stocks, 50 stocks. They think spreading their money protects them. But that's not how real wealth gets created. That's how you guarantee mediocre returns. Diversification is protection against ignorance. If you don't know what you're doing, yes, spread your money around. But if you know what you're doing, concentration is how you build wealth. Real wealth, significant wealth, life-changing wealth. When I was young, when I was actually starting out, I concentrated my bets. I didn't have 50 stocks. I had a handful, and I put serious money into each one. That concentration is what allowed me to compound wealth rapidly. So what are these 2 stocks? The first one will surprise you because it's not sexy. It's not exciting. It won't double in 6 months, but it will make you rich over time. The first stock I'd buy if I had to start over in 2026 is the S&P 500 Index Fund. Specifically, Vanguard's S&P 500 ETF. That's it. That's the first one. An index fund. And I know what you're thinking. Warren, you're a stock picker. You've spent your entire career picking individual companies. Why would you buy an index fund? I'll tell you why. Because the world has changed. When I started investing in the 1950s, there were opportunities everywhere. Stocks trading below their cash value. Companies selling for less than liquidation value. Inefficiencies throughout the market. If you could read a balance sheet, if you could calculate intrinsic value, if you were willing to work, you could find incredible bargains. But that world doesn't exist anymore. Markets are more efficient. Information spreads instantly. Millions of people have access to the same data I do. The easy opportunities are gone. So for most people starting today, trying to pick individual stocks is a losing strategy. Not because stocks are bad investments, but because beating the market is extraordinarily difficult to sustain. Even professional investors can't do it. Study after study shows the vast majority of professional fund managers underperform the S&P 500 over long periods. If the professionals can't beat the index, what makes you think you can? And even if you could, is the time and effort required worth it? For most people, the answer is no. That's why if I had to start over in 2026 with limited capital and limited time, I'd buy the S&P 500 Index Fund because it gives me exposure to America's 500 largest companies. It gives me instant diversification across sectors. It gives me automatic rebalancing. It gives me the lowest fees possible. And most importantly, it gives me the returns of American business over time. Let me tell you something about American business. I've bet on it my entire life, and it's never let me down. Not over the long term. Sure, there have been crises. There have been recessions, wars, pandemics, financial crises. But American companies have always come back stronger. Always. The S&P 500 represents the best of American business. The most innovative companies, the most profitable companies, the most resilient companies. When you buy the S&P 500, you're not betting on one company. You're betting on American capitalism. And that's a bet I'd take every time. Now here's how I'd actually implement it. I'd set up automatic investments. Every month, every paycheck, whatever I could afford, I'd automatically invest it into the S&P 500 Index Fund. I wouldn't try to time it. I wouldn't wait for dips. I wouldn't worry whether the market was high or low. I'd just buy consistently, month after month, year after year. That dollar-cost averaging approach removes emotion from the equation. It eliminates the temptation to time the market. It eliminates the paralysis of trying to find the perfect entry point. You just buy consistently and automatically. And over time, that consistency turns into real wealth. Let me give you some numbers. If you invested $500 a month in the S&P 500 for 30 years, assuming average historical returns of around 10% annually, you'd have over $1 million from just $500 a month. That's the power of investing consistently in American business. Now, could you do better picking individual stocks? Maybe, if you're exceptionally skilled, if you're willing to do enormous amounts of work, if you have the temperament for it. But most people don't. Most people are better off buying the index and holding it forever. And that's what I'd do with the first half of my portfolio if I were starting over. 50% in the S&P 500 index fund, buying it consistently, holding it forever, never selling, just accumulating. That 50% gives me a solid foundation. It guarantees that at minimum, I'll capture the returns of American business. But here's where it gets interesting. Because I wouldn't put 100% in the index, I'd keep the other 50% for individual stock selection. Because while markets are more efficient than they used to be, while beating the market is harder than ever, I still believe there are opportunities for those willing to look, for those willing to do the work, for those willing to be patient. And if I were starting over in 2026, I know exactly what individual stock I'd buy with that other 50%. The second stock I'd buy, the one I'd put the other 50% of my capital into, is Berkshire Hathaway, my own company. And before you think I'm just being self-promotional, let me explain exactly why Berkshire Hathaway is the best individual stock you could own in 2026. If you're trying to build wealth from scratch. First, Berkshire Hathaway is fundamentally a diversified holding company. When you buy one share of Berkshire, you're not buying one business. You're buying dozens of businesses, insurance companies, railroads, utilities, manufacturing companies, retailers, technology investments. You get massive diversification within a single stock. Asterisk. Second, Berkshire has zero debt at the operating company level. Zero. We have over $150 billion in cash and treasury bills. That balance sheet strength means Berkshire can survive anything. Any recession, any crisis, any market crash. We're not going anywhere. And that cash isn't sitting idle. It's ammunition. When markets crash, when stocks get cheap, when opportunities present themselves, we can act. We can deploy massive amounts of capital at attractive prices. That's how we bought during the 2008 financial crisis. That's how we'll buy during the next crisis. Third, Berkshire grows its book value over time. We don't pay dividends. We reinvest everything in the business. We buy more companies. We buy more stocks. We grow our existing businesses. All of that compounds internally. And that internal compounding over decades creates enormous wealth. The stock price follows book value over time. It may lag in some years. It may run ahead in others. But over long periods, the stock price follows book value. And book value at Berkshire has compounded around 20% annually for almost 60 years. That's extraordinary. That's how you turn small amounts of capital into large amounts of capital. Fourth, Berkshire has exceptional management. Now, I won't be around forever. That's reality. But we've built a deep bench of talented managers. Greg Abel will take over operations. He's brilliant. He understands capital allocation. He understands our culture. The transition is planned. The succession is clear. Fifth, and this is crucial, Berkshire trades at a reasonable valuation. As of 2026, Berkshire stock is approximately 1.4 times book value. That's reasonable. That's not expensive. Compare that to the general market trading at much higher valuations. Berkshire gives you a diversified collection of high-quality businesses at a reasonable price. That's the formula for long-term wealth creation. So there you have it. If I had to start over in 2026 with nothing, I'd split my capital 50/50 between two investments. 50% in the S&P 500 index fund for broad market exposure. 50% in Berkshire Hathaway for concentrated exposure to high-quality businesses. That's it. 2 positions. Simple, clean, powerful. And over time, over decades, that combination would generate significant wealth. Not overnight, not in a year, but over decades, which is the only time frame that matters when investing. Now let me address some objections. First objection, Warren, that's too simple. Surely building wealth requires more complexity than to holdings. My answer, complexity is the enemy of good investing. The more complex your portfolio, the more things that can go wrong. The more decisions you have to make, the more opportunities for mistakes. Simple is better. Simple is cleaner. Simple is more durable. Second objection. What about growth stocks? What about technology? What about innovation? My answer, both recommendations give you exposure to growth and technology. The S&P 500 includes Apple, Microsoft, Amazon, Google, Nvidia, all the big tech companies. And Berkshire owns massive stakes in Apple and other technology companies. You get technology exposure. You don't need to buy individual speculative tech stocks. Third objection. What about international stocks? My answer, both investments give you international exposure. Most S&P 500 companies generate significant revenue internationally. They're global companies, and Berkshire's businesses operate globally. But more importantly, I'm comfortable concentrating on American businesses. America has the best capital markets in the world, the best legal system, the best shareholder protections, the best innovation ecosystem. Fourth objection. What if the market crashes right after I start investing? My answer, it probably will. Markets crash regularly. Corrections happen frequently. Bear markets are normal, but that's not a reason to avoid investing. In fact, it's an opportunity. If you're investing consistently, if you're dollar cost averaging, crashes will let you buy more shares at lower prices. They accelerate wealth creation. Don't fear crashes. Embrace them. Let me tell you what happened during the 2008 financial crisis. The market fell 50% from peak to trough. People were terrified. The financial system seemed on the verge of collapse. Banks were failing. Companies were going bankrupt. And everyone wanted to sell. But if you sold during that crisis, you locked in massive losses. And if you stayed in cash waiting for safety, you missed one of the greatest bull markets in history. From the March 2009 low through the next decade, the market tripled. If you held your investments through the crisis, you recovered all your losses and then made substantial gains. That's the lesson. Stay invested always. Now let me tell you what to expect if you follow this strategy. First, expect volatility. The stock market goes up and down. That's normal. Your portfolio will have good years. It'll have bad years. It'll have years where it drops 20% or 30%. That's part of investing. Don't let volatility scare you. Second, expect compounding to seem slow at first. In the early years, your gains will seem small. You invest a few thousand and it grows 10%. That's only a few hundred in gains. Doesn't seem significant, but that's how compounding works. It starts slow but accelerates over time. You have to get through those early slow years. Third, expect to outperform most investors. By following this simple two-stock strategy, buying consistently and holding for decades, you'll outperform the vast majority of investors. You'll beat most professional fund managers. You'll beat most hedge funds, not because you're smarter, not because you're working harder, but because you're avoiding mistakes, because you're keeping costs low, because you're staying disciplined. Let me give you realistic projections. If you invest $1,000 a month in this 50/50 portfolio, if you do it consistently for 30 years, if you achieve returns similar to historical averages, you'll have somewhere between $2 and $3 million. That's realistic. That's achievable. That's what consistent investing in quality companies over time produces. And here's the beautiful part. This strategy requires almost no time. You set up automatic investments. You buy the same two things every month. You ignore market news. You ignore stock tips. You ignore economic predictions. You just keep buying, month after month, year after year, decade after decade. You could follow this strategy, spending 10 minutes a month managing your investments, maybe less. That's the elegance of simplicity. That's the power of index funds and great individual companies. They do the work for you. You just have to show up and keep buying. Compare that to trying to pick individual stocks. That requires hours of research, reading annual reports, analyzing financial statements, tracking industry trends, monitoring management changes, following competitive dynamics. It's a full-time job, and even if you do all that work, you'll probably underperform the index. So why do it? Why spend hundreds of hours a year trying to beat the market when you can spend 10 minutes a month matching the market? It doesn't make sense for most people. That's why this two-stock strategy is so powerful. It gives you excellent returns with minimal time investment. I know some of you are thinking, Warren, this is too boring. Where's the excitement? Where's the thrill? Where's the fun of investing? My answer, investing shouldn't be exciting. Investing should be boring. If you want excitement, go to Las Vegas. If you want thrills, try skydiving. But if you want to build wealth, you need boring. You need predictable. You need systematic. Exciting investing is usually losing investing. The best investors I know are boring. They find good businesses, they buy them, they hold them, they ignore everything else. That's boring. That's how you get rich. Let me give you more practical details on how to execute this strategy. First, let's talk about what specific funds to use. For S&P 500 exposure, I recommend Vanguard's VU. The expense ratio is rock bottom at 0.03% annually. That means for every $10,000 you invest, you pay only $3 per year in fees. Compare that to actively managed mutual funds that charge 1% to 2% annually. With $10,000, that's $100 to $200 per year. Over 30 years, those fee differences compound into hundreds of thousands of dollars of lost wealth. Use VOO. Keep your costs as low as possible. For Berkshire Hathaway, you have two options. Class A shares, ticker BRKA, trade over $600,000 per share. Most people can't afford that. Class B shares, ticker BRKB, trade for about 1/1,500th of the A shares, making them much more accessible. Buy the B shares. They're economically equivalent to A shares on a per-share basis. Most investors should use BRKB for their Berkshire exposure. Now let me talk about dollar amounts and how to scale your investments. If you're just starting, if you can only invest $100 a month, do that. $50 in VOO. $50 in BRKB. If you can do to $100 a month, do that. $100 in each. If you can do $500, $1,000, $5,000 per month, scale accordingly. The key is maintaining that 50-50th split and investing consistently. Let me also address what not to do. First, don't try to time the market. Don't try to predict when to buy and when to sell. Don't try to get in at the bottom and out at the top. Nobody can do that consistently. Not me, not professional investors, not anyone. Market timing is a fool's game. Second, don't chase hot stocks. Don't buy whatever's being hyped on social media. Don't buy whatever had great performance recently. Don't buy whatever sector is currently leading the market. That's not investing. That's speculation. That's gambling. When you buy what's hot, you almost always do so at high prices. You're buying after the easy money's been made. Third, don't use leverage. Don't borrow money to invest. Don't buy stocks on margin. Don't take out loans to put in the market. Leverage is dangerous. It magnifies losses just as much as it magnifies gains. And in a market downturn, leverage can wipe you out completely. I've seen brilliant investors ruined by leverage. Don't use leverage. Use your own capital. Fourth, don't panic sell during market crashes. This is the biggest mistake amateur investors make. The market drops 20%. They panic. They sell everything. They go to cash. They wait for things to get better. And by the time things get better, the market has already recovered. They buy back at higher prices. They lock in losses and miss the recovery. Don't do this. When markets fall, do nothing. Actually, better than nothing, do something. Buy more. Let me tell you what to do right now, today. Take action. Open a brokerage account if you don't have one. Set up automatic monthly investments. Buy your first shares of VU and BRKB. Make it real. Make it concrete. Make it happen. Don't just read this and think about it. Don't just mentally agree with it. Actually do it. Take the first step today. Because knowledge without action is worthless. Understanding without implementation is meaningless. You can know everything I've told you and stay broke, or you can implement it and build wealth. The difference is in the action. Act today. Start building your two-stock portfolio right now. And after you take that first step, Commit to the long term. Commit to investing consistently for a minimum of 30 years. 40 years better. 50 years ideal. Make a pact with yourself. No matter what happens in the markets, no matter what happens in the economy, no matter what happens in your life, you'll keep investing in these two holdings. You won't sell them. You won't stop. You won't deviate from the plan. That commitment is what will make you rich. That discipline is what builds fortunes. Commit today, then honor that commitment for decades. That's how you turn to simple stocks into life-changing wealth. Let me address one more critical topic: inflation. Inflation is the silent killer of wealth. If inflation runs at 3% annually, your purchasing power gets cut in half every 24 years. That's devastating. Cash in a savings account loses value every year to inflation. Bonds barely keep pace with inflation. Stocks are the best inflation protection available. Why? Because companies can raise prices. When there's inflation, companies adjust their pricing accordingly. Their nominal earnings grow. Their stock prices follow earnings. Stocks protect you from inflation naturally. That's another reason these two holdings are perfect. The S&P 500 represents companies that can adjust pricing with inflation. Berkshire owns businesses that can raise prices. You're protected from inflation with these investments. Now let me paint you a picture of what your financial life could look like if you follow this strategy. You're 25 years old. You start investing $500 monthly, 50/50ths between the index fund and Berkshire. You do this consistently for 40 years until you're 65. You never stop. You never sell. You just keep buying. Assuming 10% average annual returns, slightly below historical stock averages, you'd have approximately $3.1 million at age 65 from just $500 a month. That's the power of consistent investing over time. That's what these two holdings can do for you. But realistically, you won't maintain $500 a month contributions for 40 years. Your income will grow. You'll get raises. You'll get promotions. You should increase your contributions as your income rises. If you start at $500 a month at age 25 and increase your contributions just 3% annually to account for salary growth, achieving that same 10% return, you'd have approximately $5.7 million at 65, almost $6 million. Life-changing wealth. That's financial independence. That's never having to worry about money again. And you achieve it by following a simple two-stock strategy consistently for 40 years. But here's what most people don't understand. The real wealth isn't even in that final number. The real wealth is in the journey. It's in the discipline you develop. It's in the delayed gratification you practice. It's in the automatic saving you maintain. It's in the emotional control you exercise during market crashes. It's in the clarity you get from keeping things simple. That discipline, that control, that clarity, those are the real benefits. The money is just the outcome. The process is what transforms you. Following this two-stock strategy for 40 years doesn't just make you financially wealthy. It makes you wealthy in character, in discipline, in wisdom. And those things are more valuable than money. Let me close by talking about legacy. Because building wealth isn't just about you. It's about what you leave behind. If you follow this strategy, if you accumulate significant wealth, you'll have options. You can leave money to your children. You can donate to charity. You can fund causes you believe in. You can make a difference in the world. That's the greatest benefit of building wealth. Not the fancy cars or the big houses, but the ability to impact the world positively. The ability to help others. The ability to make a difference. That's what wealth should be used for. And these two holdings will give you that opportunity if you stick with them long enough. I've pledged to give away 99% of my wealth because I don't need it all. Because I want to help others. Because I believe wealth comes with responsibility. You don't need to give away 99%. But think about what you want to do with the wealth you build. Think about your legacy. Think about your impact. Use these two holdings to build wealth. Then use that wealth to build a better world. That's the ultimate purpose of investing. Not just personal enrichment, but creating the resources to make a positive impact. So there it is. My complete answer to what I'd buy if I had to start over in 2026. 50% S&P 500 index fund. 50% Berkshire Hathaway. Buy it consistently. Hold it forever. Simple, Powerful, effective. That's how I'd build wealth from scratch. That's how I'd grow money over decades. That's how I'd create financial security. Remember, when you're building your portfolio, you're not just building wealth, you're building the capacity to help others, to make a difference, to leave the world better than you found it. Start today. Take action. Build your 2-stock portfolio and let time do the rest.